Where did we leave off last time? I don't remember where we left off last time, but I do want to talk to you about a couple of things.
All right. I know last time we briefly covered some financial literacy topics, and we were going through some things, talking about an upcoming conference we were going to see each other at. And
Yeah, I think by the time we post this, by the time this goes public, we will be past that conference. Although I'm sure there's another one we're going to see each other in the not too distant future anyway. But I've had an interesting week this week, and I want to get your take on it and see if and what your insights are on this. I've had two sets of, I don't want to say, I guess conversations. And you see this as we go into these cycles. We've talked about cycles before, but as we go into this downturn, this economic cycle, I'm starting to see the old conversations coming back up again. People calling me out of the blue, and I'm listening and having the conversations, and I'm hearing more and more of people that are their businesses are blowing up, over leveraged, starting to collapse. And I'm starting to hear more and more of those conversations of people in the industry who just are not prepared for what's coming. And on the other end, I've heard people who are doing extremely well, extremely happy, extremely at peace, who have been prepared. And it's like nothing in the middle. I've been hearing just one or the other this past week. And so what's been on my mind this week as I'm preparing to go to this conference and I'm doing the keynote are some of the things that I'm going to be discussing. And I've had conversations with people. And so I'm curious on your take on where do you see this industry, where we've been in the last 10 years, where we are today in the industry, and then where do you see this industry in the next 10 years? What is your vision? What do you see past, present, and future?
right.
Being around this industry for so long, you've seen so much, have so much experience and where we are now. Some things are familiar, some things are not. Tell me what you're seeing.
Yeah, and I think we talked about this a little bit last time about leverage and deleveraging, and what people needed to do in their business model. But yeah, I agree with your analogy of one end of the spectrum or the other, right? I mean, either people are like really taking advantage of some of the opportunities that are out there, or they're evaluating, do I really have a viable business anymore? And a lot of that, I think, comes down to one of two things. One is their capital stack, the leverage piece, right? Do they have so much leverage that they can't, service the debt they have in place based on the returns now? Or was their exit strategy on their previous model one way and only one way, and that is either gone away completely, as is the case with folks that were selling to iBuyers, or is that just not as attractive anymore because the cost of capital is so high that the numbers don't make sense? So I think that right now people are at that point where they have to either pivot, and does that mean they change asset class? Or does that mean they pivot and just exit the business altogether and move on to something else? So that's kind of what I see based on conversations I have. And you and I have talked in the past, that presents opportunity for us, because if they're looking to reposition or rebalance their portfolios, we're able to come in and take a look at those assets. So I'm excited about that as far as what we're looking to do. As far as past, present, future, in the past, I think it was much more, and we'll call the past 10, 12 years ago, the old 2010 coming out of the 08, 09 crisis. A lot of people underwater, a lot of people on properties, not multifamily, but multiple properties like rental houses, investor, they had a mortgage they might have paid on they lived in, but then they let 4 or 5 strategically default. So we had that. Now I don't think the equity is so much a concern that the debt piece is, right? If you may have equity, if you borrowed up to the hilt and now you're getting squeezed because your rents are getting squeezed or your wrap mortgage is getting squeezed, sooner or later, one of the two have to go. And as you know, Rob, real estate's been on fire, and that means property values go up, and that means taxes go up. So even if your income's still the same and your debt's still the same, your margins get squeezed because taxes and insurance got increased.
That's right. And so where do you see, from today for the next 10 years, where do you think we go in, not only in this industry, but in real estate in general, not just in the mortgage side, but in real estate? Where do you think things are going?
Well, first of all, I think it's real dangerous to try to look 10 years out. I mean, who knows 10 years, right?
Yeah.
Let's say 5 years. So we said,
Sure.
Because, 5 years from now, I'll probably be retired, right? That's the plan. So you're going to have to learn to speak Italian if you want my opinion in 6 years, because I'm going to be over there and, and living the dream.
That's easy. All we got to do is speak with our hands, and we can communicate really well.
That's right. Grazie, prego. It's interesting because things can change on a dime. And right now, I try to get up in the morning, and do my routine, do a little, Bible study, do this, read the morning news. AI is all over the place.
Yeah.
Right. So I can't tell you what's going to happen in 5 years. I'm telling you in 5 months, that could be a factor. I mean, I was reading this morning, what is it? NVIDIA, the AI, their stock is on fire. I mean, it's like going crazy. And it's because everybody's like, this AI is way closer than you think it is. And I know we have service providers that we both use, title companies that are just scrubbing data through and using AI to complete document. No more data entry, no more errors. Well, so they say, no more errors. I mean, garbage in, garbage out. If what they're scraping was garbage, then they're just putting garbage in the next thing. But right. You know how the AI is. I mean, that's just, I don't know, in the last few months has been happening, and now all of a sudden, what's it going to be in 5 years? I mean, it's beyond what's going to be able to happen. I think the ability for us to raise capital is going to get easier. Right? I mean, it happened with the Job Act.
Why do you think that? Why do you think that?
Was it 11 years ago when the Job Act passed, and all of a sudden it wasn't as hard to do a Reg D because you didn't have to have all that, and then all of a sudden the Reg A, the crowdfunding and everything came in. I think with AI and social media, one of two things. It's either going to be real easy, or somebody kind of like the old Bitcoin FTX thing is going to happen, and regulation is going to clamp it down big time. So it's either going to be really good, or somebody's going to take advantage of people. It's going to get really tight. So I think regulation is always a key. What's going to happen in the next 5 years? I think AI is going to be a huge factor. I mean, look, we play in the home ownership space. People are always going to need a place to live. Are they going to be able to buy, or do they have to rent?
Right.
And if they have to rent, are we going to be in a position where we're going to own some properties that they can rent, and are we going to be able to cash flow those? So the math is always the same. It's just, do the numbers make sense, right?
Right.
And that's kind of what I'm saying. So I don't really want to go much past 5 years as far as trying to figure it out. But I bet if somebody tunes in 1 year from now in 2024 and says, okay, what happened since they talked? Anything we say is going to happen in 5 years probably has happened in a year or getting real close to happen. I just think that timeline is going to be compressed.
So you're retiring in a year. Is that what you're saying?
Yeah, absolutely.
So let's talk about that. When you retire, who comes in behind you? Not you personally, but globally. Who's picking up this industry when the Bob Repasses of the world want to retire? What does that look like?
That's a great point. It's interesting. When you first start, you feel like, well, everybody's older than you, and you're the new kid on the block, and you're starting. And now, everybody I talk to is like, oh yeah, I just turned 60. Oh, I'll be 61. Oh, I'm going to be, we're all in that bucket. And it's kind of like, well, what's your runway look like? And I'm like, 5 years. I wanted it to be 2 years ago. Ideally, but okay, I got a 5-year path. What's it going to look like? So what is that next? Well, you're kind of, we'll be nice and say we'll call you the next generation, even though you're not as far behind as you like.
Well, let's go beyond me too, right? Because really, it was a toss up to talk about even behind me, because I'm thinking about that as well. Yeah, I've got a couple more years in this than you do. Runway wise, I'll be here a little longer than after your retirement. But then even beyond me, what's behind me generation wise? Are you seeing any younger coming in and looking? What's that future look like?
I want to be careful not to stereotype certain age brackets and stuff, but we have generations younger than us, and I don't know if that's 40 and below, 35 and below, whatever. I have a son 36 and a daughter 30, so I got to be careful what I classify them all as. But instant gratification, and they're just used to information at their fingertips, being able to invest at their fingertips. The lack of due diligence because everything's online and they make it so easy. I think you're going to see that. And you see them just like I do, Rob. All you got to do is go on Facebook. Everybody wants to show the check they got, the gold chain they're wearing, the new car they're driving, and all that. And I don't think that's a lasting model. But they're going to say, oh, you're the old guy and you just don't get it.
That's right.
And maybe I'm wrong. But it's like you don't get to be in the business for over 30 years hoping to hit a home run once and then everything's going to be great.
Yeah, I mean, look, I personally think that the fundamentals stay the same, but the efficiencies change, right? Sure, you can use AI, but AI can help you to do better due diligence, but you still got to make a decision once you gather that information. It still has to be a semi-intelligent decision if you want to last.
I'm afraid people get caught up in the shiny object syndrome. And I think
absolutely.
Specifically some of the younger ones. We have it in our group as well. But, hey, I really like the note business. They try it for a year and all of a sudden something else comes. I like Bitcoin. I'm going to do that. Oh, wow, I really like this. I'm going to do that. And all of a sudden there's not going to be, I don't think, a whole lot of 30-year-old veterans in the note space or even in the real estate investment space, because either they're going to hit it big, make good money and move on, or they're going to struggle and just move on to the next thing that they think has a bigger payday.
So which goes to my next point then. So then do the institutions pick up the lack of players in this business later on? Do the institutions come in and pick
we
up a lot of
saw
stuff?
that coming out of 08, 09, and we saw it coming out of the pandemic, where people are like, one, they have an extremely low cost of capital.
Not anymore.
And two, they have extremely deep pockets, right? And what happens when somebody sits on a bunch of dry cash is they decide, if I'm going to be the 800-pound gorilla, I'm just going to throw a bunch of money at it, pay more than anybody else, and I'll buy the market.
Right.
And I think that the institutions are going to come in. But they also chase yield to some degree as far as, returns for their investors. So they don't suffer necessarily from the shiny object, but they pivot pretty quickly if they see bigger returns in a different arena.
So even in the big institutions, though, you still have, again, a different demographic coming up, age demographic coming up and running those funds and running those operations as well. So they run into the same challenges, I would think, as well, trying to pick up all of these distressed assets. They still have to know the business. They still have to know how to make good decisions because they're still running other people's money, don't you think?
Yeah, I think we all suffer, especially government and institutions, of having a very short memory and not learning that history does repeat itself, and we tend to do the same mistakes, every 5 to 10 years. 08, 09, banks are too big to fail. We can't have so many big banks. Now we got regional banks and smaller banks folding, and Jamie Dimon to the rescue, and Chase is going to be the biggest bank in the world again. And, what are we going to look at in 5 years, Rob? 4 banks to choose from, as opposed to, how are the little banks going to survive? And who counts on the little banks? The mom and pop, the small entrepreneurs, the people in the local community. I mean, I can go down to the bank and borrow some money. If I go into Chase, I got to give blood type, shoe size, firstborn, all that good stuff.
Yeah. And so I hear that, from the investor side, high net worth and family offices are shying away some of their reliance on the big institutions in order to manage their wealth. And some of them are even internalizing operations with their own funds, with with alternative assets and things of that nature. So with what we were just talking about, I kind of see some unresolved thoughts there, that if you have Bob Repasses of the world retiring, AI coming in, instant gratification generations coming into the business, therefore leaving institutions to pick up a mass amount of these assets. But yet the investors that usually go with the institutions are shying away from that and don't want to put their capital there. It's like this one big whirlwind of what the hell is going on. And it's like a storm there. Everybody's just making their moves and kind of counterintuitive to the whole industry. It almost seems like, from the conversation that we're putting together here.
Well, in the environment that we're in, and even in the recent past, family offices have been, we'll say, on the conservative side. They weren't chasing yields as much. They were happy with mid to low single digits, as long as everything. They were in the not necessarily full mode preservation of capital, but they didn't want to lose money. They were in there. I'd rather have a 4% return than 10 and lose money. Because if you went and pitched a family office and told them they were getting 10, they would look at you like, I'm out. That's way too risky. They didn't even hear what the pitch was. In their mind, if I get something that good, then it's too much risk for us. I don't think that'll be true with the next generation. Just the way that they've matured, I think they're going to be like, well, yeah, I should get double digits. And I think we should go after that. So I think you're going to see a changing of the guard on that family office side, which will go to the high net worth and, the generational wealth and not the self-earned wealth, right? I mean, I don't know about you, but I mean, I wasn't given tons of wealth and say, here you go, don't screw it up. I had to go out and create what I have. And, Ange and I do that, and our kids, they're not going to get, they're not hoping that my days are over so they get this big windfall. They're going to do their own thing. They live a comfortable life, but don't get me wrong, we're not Rockefeller, Vanderbilt, and all these other guys. So, but you do have those, and you have more and more of those just from, look at the tech boom. How many millionaires are there under the age of 40? I mean, can we even count them? They bought some stock or they worked somewhere, and all of a sudden, boom, you got a big payday. Right? Some people have blown through it pretty fast, and some people haven't and are, starting the family office and so forth. So I think the whole mindset for the younger generations have changed. And
I agree. And I agree with you there that they're, I think they're going to be taking more risks, just as you said. They're going to rely more on AI and other technologies to help them to get faster decisions so that they can get their deals done faster and take more shortcuts.
Here's one thing, Rod, that worries me about that whole scenario there. I feel like the generation that we're kind of alluding to comes from almost, and again, not everybody, I'm saying in general, but an entitlement background. They're entitled to make 10. They're entitled to make 12. Well, all of a sudden, something goes sideways. They're going to be the ones that are like going to litigate something, or they're going to point. It wasn't their fault for making a bad choice. It was the person that took their, you know what I mean? I could just see, I guess if I had any advice, you should be a litigation attorney in the future, because somebody's going to sue somebody over something. It already happens. Yeah, it already happens now. Just imagine when it's like, what do you mean I lost? They'll even sue them for making a 6% return instead of the 10 they thought they were going to get. I hope I'm wrong, but I just see them as like, no way. What do you mean I can't get 10%? I'm entitled to 10%. And I'm afraid of that.
So what happens then? I mean, I guess this answer comes from being a father. I'm asking you from what happens when someone who feels is entitled and doesn't get their way. I guess that's what they call the hard love, I guess, right? The tough love. They're going to have to get a little bit of tough love and just, rub some dirt in it, Junior. Just rub some dirt in it and move on. I don't know. What's that?
Reality has a way of slapping you in the face sometimes, right? I mean, you can whine whatever you want, but sooner or later, it is what it is you got to realize. Now, do you, crawl away and go on to something else, or do you man up and, I don't even know if it's politically correct to say man up, but anyway, do you,
We're gender neutral now, so it doesn't
right,
matter. Man means both, so it's okay.
yeah, do you gender up and, make
Gender
sure
up.
that you're going to learn something? I mean, it's funny. I've been in the note business for a long time, and, that it comes with the risks and such, but, my son's 36, and he's a managing director at an international bank in the risk audit department. So his risk tolerance is completely different than mine. He's analyzing the whole bank's portfolio on risk, and I'm like, oh, it's okay. Go ahead and invest in that. And, his job there is like, no, we got too much exposure in this asset class. Let's focus on that. So it doesn't necessarily always flow downstream as far as the same mentalities.
Right.
But all we can do is give them introduction to all different aspects of the economy and the different markets that are out there, and lead by example from be disciplined, from your investment strategy, and not everything's a home run. Sometimes
No,
a few singles are good. If I can convince the Yankees to quit going up there trying to hit 3-run homers when nobody's on base, maybe they would learn that, sometimes a few singles are okay.
yeah. And here is the challenge, right? And there is the challenge. Look, I was just watching that movie Moneyball, right? It doesn't matter how they play in defense as long as they're on base percentage. Just get on base and play the game. And another great line that I heard the other day too. It's it's a game that can't be won. It can just be played. So just go and play it. Just go and play it. Be a part of it. Have your disciplines. It's so important to have your disciplines. And then don't worry about the wins and the losses. It's not a game that can be won. It's just a game that can be played. Get out there, play it, do what you can, play by the rules, and
I think as the older generation, that's our responsibility, not only for our family, right? I mean, we have to start at home. We have to raise our kids that way and whatever.
that's right.
But as we're the industry leaders, we have to share that message. So in your keynote, I don't know what the crowd makeup is or was, age wise, but I feel a responsibility to, share my wins and my losses. Not everything's, rainbows and unicorns all the time. And, we have to, it is what it is. And one day they go back and say, you know what, I learned something from Bob and Rob, and they were right. Or they become billionaires and say, we didn't know what in the heck we were talking about. So it's one of the two. But just lead by, Rob, you do a great job. Lead by example, but don't sugarcoat it. That's all we can do.
That's it. It's all you can do. It's just, who you are. I was talking to somebody earlier about this as well, that I'm not a believer in the doctrination of DEI, diversity, equity, and inclusion. I'm not a believer of the indoctrination or buy into it. But however, I don't, and I'll share what I mean by that. I don't believe that we are created equal, because God made us in his own likeness and image, and we're all made up differently. I mean, the proof is right here. I mean, you're a much better looking guy at 62 than I am at 52. So obviously he's made you, a lot more handsome than I am. But we do need to treat people equitably and fairly. So the treatment of people is different from who we are as an individual. And the challenge that people have, I think, today too is, we all want to act like we're special, and we are. We all have our individual specials, but then we're not equal then. We're special in our own way, and we have our shortcomings, and we have our strengths, and we have to recognize what that is, and we have to interact with people knowing who we are and where our strengths and weaknesses are, and then get along equitably. And, it's important. And going to, as you said as well, back into the business, we have to have our disciplines. We got to know what we're strong at. You have more experience in this business than I do. And that can help to people coming into this business that don't have the experience. And we do need to help them. And I do agree with you that we have, we've been donned with this leadership responsibility for those that are coming into the business, show them the business. Because, look, we don't own the business, but it is part of our legacy, personally, you and I as well. And we do want to see it do well. We do want to see it. We want to see people do well in their homes when they get into a bad situation. I think we're an important cog in the economic wheel, this industry. And we do want to see it do well when we're not a part of it anymore. So part of that is handing the torch down to other generations with the disciplines and better leadership and things of that nature. And so I think it is important. Well, those are the questions I actually had. I was looking back at my notes to see what else I had written down, and I want to talk because this was what was happening with me this week in the business. And I heard a good line as well. I mean, it's totally unrelated, but I'm just reflecting on my week. I like gold. I think gold is a great hedge against trying to say it the right way. Currency depreciation, we'll call it.
Okay.
Great hedge against currency depreciation. That's more of an encompassing term. And I heard somebody say, we got to measure. Gold right now gets measured in U.S. dollars. Well, what happens when the dollar, is not the dominant reserve currency anymore, and how are we going to measure some of this stuff? And I was listening to this conversation, and the one gentleman said, it was great the way he said it. He goes, no, you got to look at all of these assets, including gold, as purchasing power value. How much does it allow you to purchase in your life so that you can measure your own lifestyle? And the more we can put in our lifestyle, have more lifestyle options, the more freedoms that we have. That's really what people want. They want to have their freedom to move where they want to, the freedom to choose what schools they want to go, freedom to say what they want to say, freedom, all these freedoms that we want as humans. And let's face it, the wealthier you are, the more options you have, the more you move up that socioeconomic status and ladder, and the more lifestyle options that you have. But measuring things in purchasing power value was a great way to look at some of this stuff. Yeah. And where some of the prices of some of the stuff goes. If you're looking at this just based on prices and trading, then you're not a real investor. You shouldn't even be in that particular asset class. And I think I mentioned before on one of the podcasts, our friend Jeff Watson used a term once, and I always credit him because it was a great term that he uses, of a wantrepreneur. You're not an investor. You're just a wantrepreneur if you're looking at these things and just on pricing, especially when you're just trading some of these assets. You got to look long term. It comes with a discipline. It comes with values. It comes with a purpose-driven mission of what you're on and doing, and that's how you create the legacy, in my opinion.
Yeah, and before we wrap up, I mean, I like your comments about freedom and stuff like that, and one thing I think one freedom I think we're losing right now, and that worries me, and it goes back to some of the things we talked about at the top, but just the freedom to disagree.
Yeah.
Because right now, if you disagree, it's like throwing arrows at somebody or whatever. And how can we share our knowledge and share our advice if somebody who disagrees just shuts you down and just all of a sudden you're just, it becomes this big, you don't know what you're talking about and you get slammed on social media or whatever. Look, not everybody, believe it or not, Rob, agrees with everything I say or do. Okay. I get that.
Can't be true. That can't be true.
But it shouldn't be personal, and it shouldn't be to where people are afraid to voice their opinions because they don't want everything to get stirred up. Nobody's going to learn from our experience. If we're so afraid that we've lost the freedom to disagree, that we don't share it anymore because we don't want to deal with the pushback. And I'm afraid there's a lot of people that we can learn from that just are like, I'm out. I'm not going to even get involved in it because I don't want to deal with all the repercussions. And there's wisdom that could be shared that isn't getting shared. And
that's exactly what I was talking about before, that, we just need to treat each other equitably, share ideas. It's okay to be criticized. Just don't make it personal. It's okay to have disagreements, but that's what it means to be treated equitably and fairly. Let's listen to each other. We were at the IMN conference. I don't know if you were at that closed breakfast or not. on the one morning. Were you at that one?
No, I was out working out and running my 5 miles and
Okay,
all that other stuff.
Since we like to keep it honest and the integrity on this podcast, we'll cut that piece out. Right? So I was at that closed. I was at that closed breakfast, and a confrontation broke out, and I'm sure it's not going to surprise you that I was a part of that confrontation. But there was one guy there who was talking about how he had, made his millions. He was an ex-banker out of the mid-Atlantic area, was a banker, has been doing it for 20-something years. This is the way he did it. And he was beating up on somebody who was bringing up a point about it. And of course, I chimed in. I'm like, look, there's other ways of doing it. I get what they're doing. They want to do it this way by raising equity. Raising equity is the worst way to do it. You got to do it with debt. And then it's just going, like, there's different ways of doing this. And he just totally turned his anger towards me. And, I'm always ready for a confrontation. That's fun for me. It's like a cat toying with its food, gets me awake, gets me going. But interestingly enough, that the host of the breakfast saw this going on, took control, and actually threw the spotlight on me in a positive way, saying that he saw me on stage in Seattle when you and I first met back in 2013 or 14, whatever. Because I saw you on stage pitching. I was in the audience, and you inspired me to be the success that I am today. I said, what? And he totally diffused the situation, put it in a positive light to me, and then we all just kind of just got along. That guy was like, arr, arr, arr. Like, no, we should all be getting along. This is great that, that I inspired you not even knowing that you did. And I was helping this other guy who was getting beat up by this bully. And that's the way it should be. But he got all his feathers ruffled and stuff. But listen, you got to treat people nicely and let's just move on. But I was in that just a couple months ago. I was in the middle of that.
Yeah.
But you got to treat people equitably, nicely.
I agree.
So.
Absolutely.
All right, so we'll wind down here. I will see you in a couple of days, a week from now. And I guess by the time
and as you put the bow on your keynote, just make sure you properly credit me for all my words of wisdom that you're going to use in that speech.
Absolutely. Every time, I'll put a couple quotes up from you on the screen, and I'll just put underneath as a signature, Salt and Pepper Papa.
There you
How's
go.
that?
All right. Awesome. Well, I'm looking forward to it. Hopefully we can, maybe tune in live while we're out there and tell everybody hello from Nashville. So.